Ladies and gentlemen, thank you very much for joining us today. I do have to tell you that the legends have landed. So please join us for lunch today for some extraordinary conversation from some of the legends of our mining industry who will be talking about some of the changes that they have seen in the mining industry. The moderator of today's panel will actually be Matt Gordon. Frank Holmes, unfortunately, got hung up in South America and cannot join us. But Matt and I go back a long way, and I know that the panel will be in amazing hands today. Please help me welcome Matt Gordon of Crux Investor.
Sean, well done, you got the big seat. We're going to try and extract from you guys some of the learnings that you've had over the years, over the last 3 years specifically, and what you think the future holds, because there appears to be a lack of money in the space, and I'm intrigued as to see where you think it's all going to come from. But you are legends, and you shouldn't need an introduction when we're going to ask each of you to introduce yourselves. So we'll probably start with that end of the room. Sean, do you want to go for it?
Yeah, thanks, Matt. Some of you saw me this morning, so I apologize if some of this is the same as you heard before. Sean Roosen, co-founder of the Osisko Group with Bob Wares and John Brzezinski and the rest of the Osisko machine. As we've gone forward, it's also the original CEO of Osisko Mining 1, CEO and Chairman of Osisko Gold Royalties, and currently the CEO and Chairman of Osisko Development, as well as Condor Petroleum and a few other projects along the way, and some private equity. And had the pleasure of doing a deal with Peter back in the day that ended up being a $4 billion deal, and a few other players along the way. And we're currently focused on British Columbia and Tintic in both the gold and the copper space.
Hi, I'm David Garofalo. I'm the founder and CEO of Gold Royalty Corp. I ran Gold Corp before that, and before that I ran Hudbay Minerals, and spent 12 years of my career at Agnico Eagle as CFO, and 8 years starting my career at Inmet Mining, which was taken over by First Quantum about 10 years ago.
Phil Baker. I was the CEO of Hecla Mining Company for 21 years. I've just retired. I figured if I was going to be on this panel, I would have to have some transition into something else. It seems like everybody else has at least done a couple of things, and looking forward to the panel.
Bob Wares, so along with Sean and John Brzezinski, co-founder of Osisko Group of Companies, and currently I'm a CEO Chairman of Osisko Metals, which is focused on critical metal development. So the only non-gold member of the Osisko team.
Peter Maroney. I want to start by saying that being called legends is usually a sign that you've gotten old. I hope that we can impart some of the knowledge onto people, but those of you in the audience who are familiar, I was the founder and chief executive officer, then in the end executive chairman of Yamana Gold, that was founded in 2003 and sold in 2023. And I'm now the largest investor and the chairman and chief executive officer of a company called Allied Gold, having migrated ourselves from the Americas into Africa with Allied Gold.
Thank you, gentlemen. And you're called legends because you're all successful. Let's be clear. Okay. Right. High price metals environment, super times, it would seem, but there are cracks. I'd like maybe each of you to kind of share your learnings over the last, say, 10 years in the space, and what you've seen specifically over the last 3 years, because it feels like the old rules don't apply anymore. What's wrong with the space? Sean?
Well, I think, the metal transition that we're experiencing right now with critical minerals taking the lead in the metal space is still a little bit in its infancy. Shareholders are finding their way around how to invest and how to make crucial decisions about which metals are going to be the winners, which projects are going to be the winners. So we're seeing a bit of wander, I think, in the equity space on that fact. We've got a fantastic gold price, which was over $2,300 today. But we've seen a disconnect between gold price and gold equities as central banks and as Ralph had said in his previous presentation, the love trade, everybody loves gold, but the gold equities are not experiencing the love trade at present, and we've seen a diminution in investment from the BlackRocks of the world all the way through to the Canadian pension funds, with significant amount of reduction in capital. If we look at the 2010 numbers that we had earlier this year, we're down from 40 billion to 12 billion in the UK and down from 14 billion to 2.8 billion in Canada. And I think that's the fundamental issue that we see in this space is we need the institutional shareholders back, and we also need the next generation of retail investors to be passionate about mining stocks and to be able to make money at it.
John Leapin?
Yeah, I think exploration and mine development's become a lost art over the last dozen years or so. There's been a dearth of capital available to the juniors to conduct exploration, and that's kind of the leading edge of the wave on mine development. If they're not discovering any significant deposits, nothing's going to be built. And so it's really become a process of cannibalization in the sector. It's definitely skewed towards buying versus building. We've seen that recently with BHP trying to take on Anglo. They've chosen not to build. What that tells us, I think, is that the incentive prices for metals are well above where they are right now to incentivize new exploration, new mine development, to incentivize generalists to come back into the space and displace the specialists who are hiding out in large cap names because they're facing redemption pressure.
Yeah.
They're the ones that are going to be putting risk capital work with the juniors to make the major discoveries, but they don't have the capital inflow to do that.
Anyone have anything to add to that? Two quite good points so far.
Well, I'd say, Matt, that it feels different in the last decade or dozen years or so. In Yamana, we bought Meridian in 2007. It was a hostile takeover bid. It was a complex deal. It had involved another company with a premium being paid. I'm not sure that we could do that deal today. Sean, you touched on the purchase of Osisko in 2014, I think.
Yeah.
I'm not convinced that we could do that deal today. It was a deal where we took on Goldcorp. Agnico came in on the back end of that, and we then jointly bought Osisko. So it feels different, but I come back to first principles, and first principle is that expression, that phrase, that the most dangerous thing in capital markets in investing is this time it's different. It's never different. So I don't know if this is my optimism as a mining executive, as a mining promoter. We have a tendency of being somewhat optimistic, but I can't help but feel that at some point it has to reconcile itself. Yes, the amount of investing dollars in our space is significantly below where it was. To David's point, we need generalists to come in because specialist funds don't have the money to deploy that they would have had a decade ago or maybe a dozen years ago, certainly longer than that. But the bottom line is that there's still a value proposition here, and I think the value proposition is exceptional. And at some point, the rubber does hit the road, and it isn't different, and the investing public will come to grips with it. Those of you who are on the panel are aware that I have younger children and older children, and the cohort of my older children who are now into their early 30s, it's normal to look at it and say, well, they're looking at different investments, cryptocurrencies, and that sort of thing. But equally, I'm now beginning to get that feeling that they're beginning to look at the metal space and saying there's a value proposition here that we need to be looking at. These are people in capital markets that are now starting to look at the mining space and say, this is something that I think I need to look at because the value proposition is there.
Right, and Phil, I'm going to bring you in here. I know you're a silver guy, but we saw BHP, Anglo, as David pointed out, people prefer to buy rather than spending on the exploration themselves. Mergers are equals at best. What damage does that actually cause much further down the food chain, as it were? Explorers are not able to get the money that they want to do the things they need to do. The big guys are refusing to do it. What do you think the impact of that's going to be long term for the space if something doesn't change?
Clearly the impact is less supply, right? We're not going to have adequate supply, and we're going to end up we're in this period. I thought Ralph's presentation was really interesting. The lack of volatility that you have in the gold price and the silver price. You sort of put those all together. There's a lack of volatility, so there's a lack of investment interest in the metals, which leads to a lack of investment in exploration, which leads ultimately to a whole lot more volatility in the future. And it's unfortunate because for the uses of metals that are in industrial applications, you're going to have demand destruction ultimately with that large volatility.
And do you think that the funds want to see more of this, big companies buying big companies, because it's easier for them to do what they do best, because with no concern further down the food chain?
You have different set of investors, and there's a whole swath that prefer one thing over another. So I'm not sure that's
right. I was just thinking because institutional guys tend to go for bigger companies and less retail. Bob, we better bring you in here. People use this phrase. I've used it twice today with me already. The cure for low prices is low prices. Is that a truism? Is that going to help us get out of this?
Not at all, actually. What my colleagues have said about the precious metal space, it's even worse in the base metal space. Because industrial demand is what drives, obviously, base metals or critical metals. And in my opinion, we're headed for a long-term deficit in most of those metals, which actually has never happened since the Industrial Revolution, but a chronic underinvestment in the last 20 years in exploration and development, and compounded by increasing timelines in the permitting process. It's actually tougher to permit a base metal mine than a gold mine in general. And so we're headed for a long-term deficit. And it's already too late to a certain extent. If you factor in increasing demand from the energy transition initiatives, it's already too late. Even if, for example, copper went up to $10 in the next year, it's not going to alleviate the permitting timelines that are already set for most development projects.
A lot of nodding over there. Do you want to chip in on what Bob said?
Well, silver, sort of the same message, right?
Yeah,
the silver market has been in deficit for the last 3 years. About 200 million ounces in a 1.2 billion ounce market is what the deficit has been. The mines for the last, I think 12 years have produced 800 million ounces of silver plus or minus. It hasn't grown at all, yet that demand has grown. And it's going to continue to grow with this energy transition. And ultimately what happens is you got to have higher prices in order to incentivize investors to put the capital into the project should they be discovered, because there's been almost no exploration done. So we are on a cycle where the volatility is going to be significantly larger than what it has been.
Yeah, and like obviously copper, silver, and the gold guys here. Have you been able to kind of make sense of the gold market in the last 3-4 years? It felt to me like the normal rules have not applied. It's hard to predict how to behave. And have you had to adapt the behavior of your companies as a consequence? I mean, David, why don't you go for that?
Sorry, the gold market?
Yeah, gold. Yeah, please.
You're right. I mean, traditionally, there's a strong negative correlation between the U.S. dollar and the gold price. And that hasn't been the case. Both have been going in the same direction of late. But what I think it is telling us, and gold is a very agnostic, accurate barometer of underlying inflation, is that inflation is far worse than the headline numbers might indicate. The headline numbers are absolute economic fiction. We're all experiencing double-digit inflation on the ground, whether it's at the mine site or in our own consumer habits. So I think gold is reflecting that. But if you look even over a longer horizon, gold has been a one-rate trade for 50 years. You go back to when the U.S. government abandoned the gold standard in the early 1970s, the gold price has gone from $35 to $2,400 an ounce today, whereas the purchasing power of the U.S. dollar, and for that matter, every major fiat currency in the world is seeing a degradation of 96% over that same period of time. the temptation to expand money supply is just too great for any government to resist, whereas gold is quite finite in quantity. And gold is, I would say, is a financial instrument, not a commodity. I can't make a credible economic argument based on demand and supply. I mean, everything that we've ever mined is sitting above ground anyways. But it is a currency that's trading relative to the other currencies that are being continually degraded.
Right, and Sean, I'm going to bring you in here. Obviously, I take what David said on board, absolutely, but back to the component of the last question, which was, right, how have you had to adapt the way your companies have, gone into market or talked to the market and driven that narrative? Because building big companies is one thing, driving share price is another, so what have you had to do?
Well, my sweet spot is really sort of exploration, development, and transitioning to production, and that's sort of the house that we live in. Both Bob and I and a few other the players share that passion, and that development stage, transition, exploration, development stage is the house of pain for a lot of investors as we go through the time value curve, often referred to as the Lassonde curve. What we've seen is that curve has gotten a little bit longer, and we really need shareholders that have long-term visions, which is hard to find right now, to go through those cycles on the development. On the exploration cycle, the cost of exploration has gone up because we've found all the easy stuff. The exploration that we're executing now is generally blind targets undercover in the middle of a swamp or something, or in some jurisdiction where there's extremely tough infrastructure costs. And we're seeing the access to exploration dollars, which I would call R&D, is the hardest dollar to find. And that shareholder has been hampered in such a little bit of the fun is out of it, because the junior mining industry in both Australia and Canada used to be kind of a casino environment. It still is more so in Australia than it is in Canada now. So we've kind of lost that audience a bit, and the younger generation has moved into things like crypto and others. So as an industry, we need to be pretty creative about getting that excitement and the story back in the game where there's some passion for it. I think there's some opportunities to correlate some of the stuff that's going on with tokenization, with crypto, with blockchain into the exploration side. But it's going to require some creative effort that maybe I've got too many gray hairs for.
Well, we'll come on to the topic of bringing younger people into the space in a second. And Peter, I want to before we kind of get into the where the new money's coming from, or how we get more money back in the space, or share price, just talk about some of the other factors driving or even restricting, in a way, the ability to mine economically. Now, you're in West Africa, and the guys in Canada will say, we've got the best location. Africa wouldn't dream of going there, but you've got, what, 3 projects? 3 mines at the moment?
3 mines, yeah.
Yeah. How's business in Africa?
So, we are in an exceptional province in this country for mining, where the code of conduct and the rules for what you have to do to get a project through the spectrum to ultimately produce something is better understood. But generally in this country, we talk about Canada as a sort of monolithic place, but Canada is, how do I say this elegantly, mining in Nunavut is not the same thing as mining in northern Quebec, where there's infrastructure and support. But the bottom line is, I think that it is misguided to look at jurisdiction and say that a jurisdiction is better than another jurisdiction without looking at all the factors that go into returns. So I look at it from the lens of what's the return and how to get the best return. If in West Africa, we are fully permitted, but if in West Africa or many other countries in Africa, you can be permitted in 2 years, and I don't know the people on the panel here, but what's the permitting time frame in Canada? Is it infinite?
5-ish.
Slightly less than infinite?
We're at the final end of the permitting process in BC. Its legislated timeline for EA is 3.5 years and another year for construction. So 4.5 years is the goal.
But the bottom line is, in a lot of this country, it's very difficult to have a firm grasp on what the permitting time frame is. And so I look at it and say, well, permitting is one of the factors that go into returns. There are other factors. So let's look at it from the lens of what is the return, rather than monolithically and sort of at a high level. Canada's a better jurisdiction than Cote d'Ivoire. Canada is a good jurisdiction on certain things, but not the best jurisdiction on other things. let's go further. There have been several people on the panel here, Matt, that have talked about exploration and the importance of exploration. There are some areas in Africa, the Birimian Greenstone Belt, the Arabian-Nubian Shield, that are obscenely underexplored, and they are prolific, and there's gold literally everywhere. We're just scratching the surface, literally scratching the surface, in the sense that these are open pit mines. We haven't even gotten to the underground part yet, and we don't have to get to the underground part because there are a lot of opportunities near the surface. And that's not something that one sees in Canada. So what I would implore investors is to keep more of an open mind, but more importantly, look at it from the lens of what are the factors that go into the delivery of a return rather than just jurisdiction versus jurisdiction.
Right. No, I thoroughly agree, and having worked in Africa, 25 countries, I support you. What are the other factors that are holding us back here? Because it feels like mining companies are trying to do things the right way. They're under more and more regulation, more and more controls, more and more people leaning in. NGOs, having a view on this, social media having an effect on this. How different is it today compared to, say, 20 years ago? Do you want to go for it as well?
I don't think, yes, we are responsible in what we do. Maybe not by comparison to 20 years ago, but let's say 40 or 50 years ago. We mine responsibly, we take it seriously. I think the Canadian mining industry, and as it has exported its talents abroad, has always been reconciliatory, approach to local communities, is part of the critical path. We have a certain way of doing things that I think works out well in many parts of the world. I don't think the issue is the mining industry. I think the issue is the correlation between what's happening with metal prices, gold price in our case in particular, and what's happening in the market. This industry is a comparatively, but that goes to how do you do it effectively, because you do have to get dollars that get invested into the ground, and where do you find those dollars? It's a small industry. The precious metals mining industry can't have a market capitalization cumulatively of more than maybe $350 million. That's roughly 1/7, 1/8 the size of one of these behemoth technology companies like Apple. Exactly. I kidded someone recently, I thought I was saying it in jest, that the amount of cash on Apple's balance sheet is more than the market capitalization of our entire industry. And the person that I was saying that to said, that's not funny, it's true. So the bottom line is this is a small industry. We're competing for dollars. The investor base has been somewhat decimated. It's certainly significantly less money today than was available a dozen years ago or longer. And we have to find a solution to that. I don't have a solution at this point, other than what was said by others on the panel, which is that we do have to go to fresher fields. We do have to go to generalists to make the case. But in making the case, I think part of what we also have to do as an industry is say, what is the investment thesis? Is the investment thesis free cash flow? Is it cash flow? Is it the inventory of ounces that are in the ground and the optionality on drilling and finding more ounces? Is it net asset value? I think it's a combination of all of these things, but I think over the last, I welcome the thoughts here, but over the last dozen years or so, there's been such a widening of the spectrum of what investors are looking for that it's very difficult for mining companies to say, this is how we reconcile what we're doing to what you want.
And Bob, what do you think?
Yeah, the other factor that's changed enormously in the last 20 years is public perception of mining in North America. It's literally tanked spectacularly, driven largely by NGO activity. The failure, to large part, is on our side. We have failed collectively to promote our industry, to adequately address the issues and clean up our image. And it's so easy for the public to trash the mining industry. In fact, the biggest polluters, the industry that pollutes the most in North America and has the largest environmental footprint is farming.
Yes.
The footprint of the mining industry is less than 1% compared to farming. Who attacks the farmers? Well, it's a tough thing to do. And, can the NGO attack the farmers comparing a beautiful bucolic hill with the cows munching on the hay compared to a big hole in the ground producing noise and dust and pollution? mining's an easy target, and it's always going to be the main target of the NGOs because they basically finance themselves by attacking easy targets, by being very vocal in the media. NGOs have become a business, right? Environmental movement has become a business. May as well attack the low or pick off the low-lying fruit, which is mining. And this problem is not going to go away.
It's not going to go away unless people like Phil come together with the Gold Council and others and maybe start talking about the mining sector rather than specific commodities, because individually you're all quite small with vested interests. Do you think there'd ever be a collaboration between the different commodity representatives and fund proper, meaningful conversation? We've seen it in the uranium space for the last 10 years since Fukushima. It's been, lots of misinformation, Greenpeace, etc. We've seen it well, just open pit mining is frowned upon everywhere without actually saying, well, what are the benefits? It's the least worst option kind of thing. How do you guys crack this, Phil?
I couldn't hear the.
You can hear. Oh, lucky.
It's not. It's with the echo.
Yeah.
I'm getting echo. Apologies. Not better.
No. It's just the.
Short question. Do the various institutional bodies, Gold Council, Silver Institute, etc., need to come together and promote mining properly, give it a fair hearing?
Sure. I mean, there's absolutely a need to come together. But on the other hand, I would say that there's just been a lot of progress that's been made. And while we haven't seen it flow through completely, use your BC example, you have seen legislation that has been put in place that is changing. In the United States, we've had the same thing. There's more that needs to happen, and so there is more collaboration that needs to happen between, the National Mining Association, the World Gold Council, the Canadian Mining Association, in order to continue to drive those improvements in policy. But there is the recognition by policymakers of what you were saying this morning, Sean, that we have to see changes. Are they inconsistent in the actions that they take? Absolutely, but there is a growing recognition of change, and to me that's very optimistic for the industry.
Right. So I can excuse the gold guys. I can see why copper is a critical mineral. I can see why silver has become an industrial and therefore critical mineral here. The gold guys, how do you put pressure on government or otherwise? Because the IRA is great for you two, well, downstreamish.
But gold actually leads the way in many respects, and so as a result, the other industries sort of follow in the wake of the gold industry, and there's a recognition that we got to keep everybody in the same bucket.
Right. So we better get on to money, hadn't we, David? Always keen to talk about money, this guy.
Well, no, I was just going to say that it's hard for me to make a case on industrial utility for gold, but what I would say is there's tremendous social utility in gold, and having a means of trade, a means of currency, a means of barter that you can trust, when clearly you can't trust fiat currencies, has societal value. It creates order in the universe, and I think that's extremely important. But I don't think it's a PR issue for mining. I think it's really driven by economic imperatives. And look at what's happened in the uranium space. Nobody's crapping on uranium anymore. Everybody understands the utility of uranium in terms of decarbonizing the global economy. Suddenly nuclear power is in vogue, and NGOs are actually supporting it. I think that sort of evolution in thinking is likely to happen in many of the metals that we produce, whether it's copper or zinc or anything that has significant industrial utility in a decarbonizing world.
Okay. Should we get on to the money? Because I think most people want to understand what the future of mining looks like, and there is no future unless we get that money back. Sean, you mentioned 40 billion going down to 12 billion in UK, Europe, I think it was. And something in like 14 going down to 2.5 or 2.8 in Canada. That's a lot of money that's left the space.
Right? Well, that's since 2010. So if you were to put everything in real dollars as of today, it would have been sort of more like going from 100 billion to 12 billion.
Yeah, that's pretty depressing.
So
what do you do to get them back?
It's a huge exodus from the investability of the space, and I think that the fundamentals, that we're competing with. I mean, we have the Amazons and the Googles and the 7 so-called golden children that have soaked up so much investment in the world. But one of the other things to look at is in the oil and gas business, it's 4 years to permit a project right now on average. It's 14 years in the mining business. So it's no wonder that investors are there. So we come back to the regulatory issue. And on the gold issue, we come back to the fact that there is no replacement to gold in our industry right now. With political turmoil being it is, the US dollar is the most successful fiat currency in history. And it's on shaky ground right now, depending on who you talk to, if you're sitting on this side of the Atlantic or on the other. So, gold has got that space in there, and we need primary investors and people that have, $6.6 trillion under management, like BlackRock, I think it is, to be taking a larger allocation into the primary space that they're not doing right now. And we need, commodity prices are not reflecting what's happening here. We're saying we need 300 new mines to take care of the energy transition. Now, we've only built 270 of them in North America in the last 200 years. So we're talking about doing, in 6 years of doing 200 years worth of work here. It's not on.
Not gonna happen.
So we need, we actually need more speculation from the institutional space about commodity price than what we have right now. And we need commodity prices to move. And I don't know if that's going to require some more stimulation from regulators by saying, that we need all these electric cars and we need these decarbonization technologies, but it's not reflected in the metal prices. Like, the metal prices are reacting like this is not going to happen. That's the message that I look at from a market watcher standpoint, is that if I look at copper and I look at iron ore, I look at met coal, you're telling me that this is not going to happen. Like, it just doesn't make any sense where we are right now. So those commodity prices need to have that speculative nature back in them. We need them to move, and we need to get on with this process. And decarbonization by 2030 is not doable at this point. There's just no way. So that when that market sort of hooks up, if you will, and gets some traction, I think we see commodity prices kind of lead us out of this discussion, and we see an allocation of large capital going back into it. I think the other aspect of life is technology. Everybody's caught up on the AI boom right now. But as an old, one of our friends had said back in the day, natural born stupidity will trump artificial intelligence any day of the week. And that's certainly what we're seeing in the equity markets at present. We just haven't seen the break in the ranks. And I think that, if we look at our industry as a micro industry now, because it used to be fairly big, you go back to the turn of the century, whaling was the #1 industry worldwide for light and energy. We're seeing, what's happening in the Middle East. Saudi Arabia is leading the charge with a 50-year plan and no elections planned. And we've got an energy country like Canada and an energy country like Venezuela who can't figure out which way's up, in terms of their energy policy. So all those things are bubbling away in the surface, and I think that we need to see these commodity prices sort of lead us out of this.
But I guess the difficult thing for me to understand is how institutional guys and gals think about this space now, having left in vast droves. The ones that are left, maybe they're making out fine, maybe they're unhappy, I don't know. But it feels like there's going to be some joined up thinking here between government on the critical minerals side of things. We've seen a lot of industry, OEM specifically, with copper, with nickel, lithium, etc., moving upstream, but it's still a highly risky space. So is it possible, is it ever going to be possible for the joined up thinking in this space, or is everyone, each for their own? In which case, how do I as an investor make my bet? What do you reckon, Bob?
It's a question of perception. Take the case of the depot here in Quebec, for example. Their mining portfolio is a fraction of 1%. And yet, I believe it's 23, they lost $33 billion in cryptos. You're going to tell me that cryptos are risk-free?
No.
There you go. If they had invested $33 billion in mining development in Quebec, it would be a very different local scenario.
Dave, what's it going to take to get the institutional boys and girls back?
Sorry, I missed part of it.
We're doing the same thing. Wow.
Yeah, it's really, really hard
I should have sat in the middle. What's it going to take to get the institutional money back? What does mining need to say, do, behave like, and actually deliver on?
Well, I think we need to make economic cases for new deposits rather than recycling old ones. That's what attracts capital. If there's growth in the sector, that'll bring in new capital in, and there hasn't been growth. There hasn't been reinvestment back in exploration in a meaningful way for, well, at least a dozen years, and so we have seen a shrinking pie, and so it's a reverse dynamism, if you will. It's keeping generalist equity away. But I think inevitably what will draw capital back is, and Sean touched on this, is some momentum in the commodity price. Incentive prices have to be much higher than where they are currently in order to incentivize capital to come back into the space and incentivize exploration and mine development. That'll draw, it's a bit of a vicious cycle right now, but eventually the cycle will break just because of the economic need for these metals. Eventually our society is going to require this metal, particularly on the decarbonizing side and base metals, copper in particular. Supply is at a pinching point right now. Demand is burgeoning, and there'll be a breaking point, and eventually you'll see a very volatile, violent upward move in the copper price, and then you're going to see a flow of capital from the generalist investors that otherwise is lacking currently.
What about, I mentioned, sorry, go on.
Yeah, the key word is sustained momentum.
Right.
Yeah.
In the copper space right now, the institutional investors I speak to say, well, another flash in the pan. So we're going to need, just to get them back into the copper space, I would say at least 6 months to sustain high copper prices.
Yeah, and the question is, what's the tipping point for that
Yeah.
sustained momentum? And it's hard for any of us to predict, but when it happens, it happens violently, and there is sustained inflows of capital at that point. I've been theorizing that would happen for the last 5 or 6 years. I've been wrong. My timing is completely off. I don't know what it'll be, but there will be a catalyst at some point, and we're going to see sustained capital inflow out of the Darling 7 and the IT universe, where we've seen stretched valuations beyond recognition, into a sector that's very, very undervalued relative to its societal need.
So, Bob, you quite hard on the prospects for gold production. The demand's there, but production, you reckon, even if it goes to $10, it's still too, like tomorrow, it's still too late. What's got in the way? Has it been governments not understanding the pressures there? We saw that in uranium.
Well, it's because there's a complete disconnection between the commodity cycles and the government policies, specifically regarding to permitting process.
Right.
If governments, even in this country, could significantly streamline that, would have a huge impact. In the last budget, the Trudeau government promised to maximize the federal processing at 5 years. Well, already that's actually a lie, because the federal process is kicked off once you've submitted your initial project description. And as it stands, the federal government requires you to do the whole year of public consultations, both communities and First Nations, before they even allow the process to kick off. So it's actually 6 years in this country, minimum, to get through the federal process.
Could they speed that up?
Of course they could.
Yeah.
There is one government policy that clearly works and has been rewarded, and that's flow-through incentive shares in Canada, especially here in Quebec. The Osisko Group, Osisko One got sold for $4 billion. Our royalty company's worth $4 billion. The rest of the companies add up to another $3 billion. All of that value creation came from government regulation about creating a flow-through share system. We would have never been able to drill Malartic without flow-through. We wouldn't have been able to drill Windfall without flow-through. And we've been probably, as a group, the largest user of flow-through in the history of Canada, and that's a government regulation that's known. It's been around for 30 years now, and it's generated billions and billions of dollars for revenue for the Canadian governments in terms of revenue and tax revenue. And I think that kind of regulation, where you're actually stepping into the flow and saying, okay, we're going to redirect risk money and we're going to create this primary investment. We talked to the guys from Pear Tree today, who are probably the biggest sales group of flow-through. We've raised over $400 million in the last 10 years with them that we would not have ever had access to take that risk with had that not been there. So I think the flow-through investment regulation is something that every government in the world should be looking at. I know there's a few programs in Australia done, but no other government has done this. There are tax incentives that are there, but when you look at what the oil and gas industry has been able to achieve in terms of tax planning around the world, the mineral industry is nowhere near what they've been able to achieve in terms of tax holidays, exploration repayments, risk. We saw Saudi Arabia now gives you $2 million. The first $2 million to go in and do an exploration program, they pay for it. So there's government regulation that needs to be more proactive rather than just punitive. The unfortunate part is the last 20 years of government regulation has been more punitive, just in terms of creating more demand and turning mining companies into water management companies and allocating capital into different consulting groups. On the average project right now, we were counting it up last night, we can have 10 or 11 ESG consultants by the time we go through everybody. By the time our 2 or 3 First Nations groups have their group, the government's got their consultants, companies got their consultants, and then your primary investments and your debt bankers have theirs. This is all being paid for by the asset, and we need better regulation on that standpoint to sort of control those costs.
Right.
And we also need the risk to be shared by the people who are going to benefit from it. Like in Canada with flow through, the government says, okay, if you take this risk, you can have a tax benefit.
So, I mean, it sounds to me, in some ways, it sounds to me like there's a lot more hoops going to jump through in terms of money. You guys should be held accountable, by the way. There's nothing wrong with that, and I'm sure none of you mind that. But the process should be speeded up, because I think the money's there if you want it. I was talking with a friend of mine at Rothschild last Friday. He said, we've got loads of money, we want to deploy it, but these guys can't seem to actually lay out the wares in a way that we understand. So that's good news.
Sorry, and I'm sorry. They're saying that we want to deploy capital, but the mining companies are not showing us what the prospect is, and I would totally disagree. I think the mining industry is demonstrating that what the prospect is. We're showing what it is to be responsible mining. I don't think that the money is there to anywhere near the extent that this person may have said to you. And if it is there, it is on condition that it's very difficult to deliver returns. And I come back to the comment about returns. So we are self-funding our business. We have a growth in Allied that goes from 400,000 ounces to 800,000 ounces, but we're self-funding it. We're doing it through cash flows and available cash. And the reason for that is that if I went to project financing, to a Rothschilds or to others, it would suck the life out of equity. It would suck the life out of me. And so the bottom line is, if the money is there, it is there on terms that are so onerous that it's very difficult for a company to say, I can deliver the return that I want to deliver. And coming back to something that you were asking before about the money and how do we return this industry back to its glamour, I think the answer is, again, we will return it back to its glamour, but it's going to require several things. We will have to have more investment dollars that are available in the marketplace. We will have to have a frame of reference of what it means to be a precious metals mining company or a copper company. What's the thesis? I confess, I don't get it. I don't understand. Nobody that invests in cryptocurrencies, nobody, Sean, that invests in Bitcoin says Bitcoin is going to $10,000 per coin. They're all telling you that it's going to $150,000. And yet in the precious metal space, I find that there are analysts that are putting models out there that are assuming $1,853. I don't know where you get the $3 from, by the way, but the $1,853 per ounce on a long-term basis. Well, why not put $2,400 into your model and see what that does to the value proposition? And that's part of my point, which is we need to more deliberately talk about what we think is the value proposition. We need to redefine what it means to be invested in mining companies, and in our case, in precious metals mining in particular, and find those dollars out there, because the value proposition, in my view, is there.
I think we've run out of time, folks. So I hope everyone enjoyed that, got something from each of these fine gentlemen, legends. So Peter, Bob, Phil, David, and Sean, thank you very much for your time today. I'm sure people will approach you with more difficult questions than I gave you. So do go and see these guys directly if you want to. Thank you very much.
Thanks very much.
Thank you.
Thank you.